They just reported results on Monday. We have CEO Sebastien St-Louis and CFO Trent MacDonald. Welcome to both of you.
Morning, Pablo.
Morning.
So, Sebastien, let's just start. Maybe if you can make some introductory remarks, and then we'll jump straight to Q&A. I have some questions myself, and then we'll get some questions by email from participants also. Thanks.
Thank you. Perhaps a lot of our listeners here are familiar with the HEXO story, but I'd love to level set on strategy as we go forward. I think there's a number of core differences in how we're approaching the market and why I believe HEXO has a solid shot at becoming one of the top 3 cannabis products companies in the world over the next 10 to 20 years. It really starts from a piece of strategy. We believe that a focus on product and innovation is key. That product and innovation needs to be underlined with profitability, but more so that the company is very much focused on the products that we produce. So what I mean by that and why that's an important point of differentiation. One, it's a market target. So we are not in the medical market. We believe that the legalization of cannabis presents an opportunity to move away from prescription wellness and to move into adult use well-being, which of course includes recreational. So that's a very different focus from a channel perspective. We don't target clinician channels typically. We target adult use sales or recreational markets, which go through retail channel, and we're building and really focusing on the products and the technology that we call Powered by HEXO. Powered by HEXO is the third piece and the third leg to our strategy. And so we build our products from a core cannabis product offering. And now post-consolidation, Pablo will talk about the M&A we've been on. HEXO is number 1 currently in Canada in the recreational market, in the flower category, in hash. We're number 1 in pre-roll. We're number 1 in oil, number 1 in gel caps. We're number 1 in beverages. And we recently became number 1 in topical creams. This is all from a recreational market share point of view. So we know our product very well. And our consumers are responding to that and saying, hey, this quality is great at the price point it is. I want to purchase more of this product. And I may add that HEXO is quite good at producing these products at a profit. We have some of the best gross margins in the industry. So recent quarter had a bit of pressure, but we were still amongst the best at about 28% gross margin. And previous quarter, we were clearly in a massive lead with a 35% gross margin. And that's because of the reinvestment in technology. So there's all those core cannabis products in which we're number 1, and one stands out taking a bit of a different path to market than just the direct HEXO to retail, and that's the beverage category. So with the beverage category, HEXO has partnered with Molson Coors, and we've taken an absolute dominant share in Canadian beverage. We've innovated a whole series of beverages, from beers to juices to lifestyle sparkling waters to flavor-forward tonics under our House of Terpenes brand. And we've taken about a 46% market share after being second to market. So we were 6 months behind the incumbent. The next biggest leader in beverage has a 25 share in Canada. So HEXO is supremely dominant in that category. The reason we were able to do that is through this Powered by HEXO partnership strategy. We focused on the technology of cannabis, so which involves really 3 buckets. So operational scalability, how can we make this profitable? Need states, so how can you make this relevant to a consumer? So for either sleep, sexual health, fun, whatever we can derive from cannabis. And the third category is how do you get those need states into the body in a safe and pleasant way. So again, with beverages, our nano emulsion technology was one that allowed to get the uptake of that need state within 15 minutes and have a very pleasant experience with low dose. Those 3 categories are what we're focusing on and wrapping in to what we call the Powered by HEXO formulation or technology. We then seek partners in specific verticals. So in the case of beverages, Molson Coors, to handle the distribution of that product. And this is internationally, so including Canada, the US, but also outside of North America eventually. But then we also look to them, and this is the most important piece, we look to them for consumer insight. We have phenomenal consumer insight on pure cannabis play. We've invested quite a bit on that, and we invest quite a bit on interfacing with retail and getting consumer insights there. But when it comes to new categories, beverages, functional food, cosmetics, we believe that there are very successful companies out there in the world, Fortune 500 companies, that would be extremely difficult, if not impossible, to displace. We don't believe we're ever going to invent the best chocolate chip cookie in the world. There are plenty of companies out there that make phenomenal chocolate chip cookies. We do believe we are in possession and will continue to innovate around the best cannabis technologies in the world. So the idea is to find those partners that have the best chocolate chip cookie in the world, the best face cream, etc., and to partner with them to insert that powered by HEXO technology into that product, and then to lever their distribution to get mass market adoption on a low cost of capital. So that's HEXO in a nutshell. There's a number of big wins coming that surround all this, and I'm sure we'll talk about it during the call. So looking forward to the questions.
Okay, that's great. Thank you, Sebastien. So look, let's start. Let's look at the performance of what I call Heritage HEXO over the last 2 years, right? And then and let's talk about how the recent deals, the 3 deals you announced, Cannabis, 48 North, and Redecan, help you in terms of the domestic market and of course internationally. And the only point I would make is that obviously, if I look at the performance of HEXO over the last 2 years in the recreational market, you've got very good growth outside of Quebec, right? The scanner data shows that. So you build market share in other provinces, while Quebec became more competitive, right? But as you say in your call on Monday, you still remain number one there, although we probably less share than at the very beginning. But just characterize your performance in the rec market, provinces, formats, price segments, and then talk about how these deals help you in the domestic market specific.
Wonderful. Thank you, Pablo. So I'll let Trent really dive into the detail here, but I think the takeaway from our last quarter, HEXO legacy, if you want, so pre-acquisitions, was one of the fastest growing, if not the fastest growing company amongst all the public licensed producers. At last quarter, we were 94% year over year. We're over 50% year over year at even in a challenging quarter, which was our Q3. A lot of that growth is coming from the adoption of our brands outside of Quebec. So we had 169% growth at Q3 coming outside of our core market of Quebec, so, which is just way ahead of anybody else. We're doing all that at one of the best gross margins in industry. And all that, to your point, Pablo, while remaining number one in Quebec. We did peel back. I mean, at one point, HEXO had a 50% share in Quebec. And that's in any CPG, we don't believe that's long-term sustainable. It's very expensive to defend a 50 share in any one market. We believe that the number one market will be between 30 and 40% share. And we do believe we can work our way back up to that, not only in Quebec, but eventually in Canada. We're currently number one in recreational share across the whole country. We're number one in Quebec, we're number one in Ontario, we're number one in Alberta, and we're number one in BC. This is on a post-consolidated basis. And that is all amounting to about a 17% share nationally. So the market's still highly fragmented with 566 total producers, 90% of the share being split between the top 10. And so I believe that the reason it's so important to be number one, and this has been part of our strategy for the last 4 years to make our way up here. The reason it's so important is because that's where the growth comes. The number one player, if you accept that in a few years will be between 30 and 40 share, well, that gives us a good double in share if we remain number one, right? We're at 17, we could probably get up to the mid 30s over time. That's certainly the goal. So beyond Canada, we're also entering in the US, of course, so I'm sure we'll talk about that in a moment. But before that, I'll let Trent kind of dive into a few more key numbers around the HEXO performance.
Yeah, look, the overall performance in Q3 wasn't what we had wanted. Obviously led, of course, in Quebec, and really that's the crux of it. We had a $3.6 million one-time charge as a tax levy that obviously impacted our EBITDA. Adjusted EBITDA as reported, but that is a one-time. So, the 28% margin, like I said, versus 35% margin historically, which is our comfort zone, the mid-30s. Sometimes we could possibly push that further, but we like to reinvest that back in price to create volume. So, we believe very strongly that we will be getting back to those mid-30 range in the very short future. Call it 1-2 quarters. We also believe that our SG&A is coming under control as well. Our SG&A took another downward movement, and another $1.2 million decrease from Q2 sequentially. We are now in a really great position that as we strive towards increasing our sales, we have these targets that we've suggested to people that we would really like to get our SG&A at annualizing under 20% of net revenue by fourth quarter of next year. So only 4 quarters away from where we are right now. And if we did that, we would be best in class, as certainly as it sits today, and it wouldn't even be that close. So look, there's lots of things that we're doing right. We talk about investor capital, and when we use investor capital, we take that seriously. Historically, we have used, including these 3 acquisitions, we have used under $17 million for every 10 basis points of market share we have in adult use in Canada. The next closest to us is at about 27 million. That's what we have for Tilray, and then it goes up from there all the way to 85 million for others like Canopy, for every 10 basis points of market share. So look, we like what we've been doing financially. Our balance sheet is still very strong. We have de-risked it on the PP&E, goodwill, intangibles, very low depreciable capital base. In addition to having strong inventory and inventory controls, so we're not taking all those provisions and write-downs that you see in other LPs. So we've done a lot of good things, and we see a real path here to positive EPS, despite what people might look at as our Q3.
Understood. And I'm just talking more in general terms. I'm more focusing on the top line in terms of sales in the recreational business. So let's delve deeper there. Sebastien, maybe you can talk over the last 18 months if you want, but I'm talking about the performance in the recreational business, right? First, Daily Special was quite successful, right, on the 28G, on the lower end of the market. Then you introduce up more on a higher price point in flower. You've done very well in concentrates, hash. So what I'm trying to ask here in terms of the performance, it's more on the recreational business. Talk about the things that have worked well, things that could be done better, and how, again, 48 North, Redecan, Cannabis help you in terms of your performance in the recreational market in Canada.
Sure. I think HEXO was instrumental in really defining where the consumer would be, Pablo, with our original stash launch, the 28-gram bag. When this was about 2 years ago that we did, no worries. This was about 2 years ago that we launched Original Stash, and it was met with wide criticism across the industry. But what HEXO did is we identified the existing black market consumers and their needs, and we responded with a product. So probably the most successful product launch in cannabis history ever, anywhere. And I say that because we would actually see the 28-gram format become almost 40% of the total market after basically you had a huge criticism against it. And then everybody jumped in and tried to copy and clone our product. And so the challenge was on the format, the challenge was on the price. And the format was something that was really driven by consumer need. These were patterns of how they purchased and how they enjoyed purchasing, how they supplemented their existing variety. The second piece was really on price and realizing that the real market in Canada is the black market. And so that is where we need to go focus to find out what the pricing really is, because that pricing is not driven by supply side constraints, by margin targets. It's truly driven by equal competition and the consumer. And so HEXO invested quite a bit in terms of those products, in terms of automation, in terms of being able to package, in terms of quality, to the point now that our Original Stash product and double blind test gets some of the best quality reviews in market and can actually compete head to head against craft product at our latest round. We continue to innovate on flower. That was a huge win. We then continued to innovate on this black market strategy with the introduction of hash. And we, at the launch of our hash, that took about an 80% market share into that space, just absolutely massive. We saw other entrants start to come in, and we got pushed down to about 50% right now nationally. The miss there on our hash, and I can talk about the success. The success, again, was really identifying a consumer needing concentrates. I think anecdotally, the future concentrates market is the place to go fish next. So HEXO is focused on that. When we talk about shatters, waxes, live rosins, there's about 20% of the consumption, I believe, that's there. And we've largely displaced the black market in flower with the original stash product, but the black market has thrived under concentrates. So I really think that's a great indication of where to go for both price and product. But the miss on hash that we did is we were the only game in town. And we got arrogant, and since we could not fulfill all of demand because there was just insatiable demand for a hash, was a great product, we decided to create it at a lower concentration in order to create more units. So we shipped in at 22% THC, which allowed us to make a better total number of units, which we believed would push sales further. What we underestimated was the speed, not of the large major competitors, that we had a very good understanding of, and they were not able to compete on our hash. We estimated the lead time correctly. What we underestimated was the innovation of the small startups and the craft producers. And they came in, it was within 3 weeks of our load in of our 22% THC hash. And they came in Quebec with a 28% THC hash offering, which was a very good quality. And so our velocity took a nosedive in the Quebec market. The Quebec market regulatory threshold, by the way, is 30%. So that's as potent as you can make the hash. HEXO has the technology to make it at 30%, but if you do that, you're consuming more cannabinoids. So you have less total units and less total dollar throughput. So we made a bet on volume, and it didn't work because the craft guys came in very quickly. We've since adjusted that. So now the hash coming off the line is there's nothing coming in under 27.5%. So it's going to be between that 27.5 and 30%. The quality, and we're continuing to invest on automation so that we can drop pricing in the future or increase margin, depending on the case and where the market shifts. So we're very happy with that. On the flower piece, I think the largest miss there, and it wasn't so much a miss as in terms of key learnings, and I think hitting on 8 out of 10 in the right way and missing on, say, a 2 out of 10. So you can't get everything perfect when you're innovating. This is still a 2.5-year-old industry. But the miss overall was this. We went in and we wanted to improve our strain portfolio. This is a year ago. So a year ago, we said there's a shift in consumer preferences. We're starting to see people look for more variety. We're starting to look to people to seek a higher THC. So we immediately started improving the strain portfolio. We ran in our genetics lab a couple tests. Those tests came out beautifully. So then we turned to our greenhouse and we said, okay, well, we need to offline some of this productive space in greenhouse to make room for these new strains, which are very exciting. Unfortunately, the space we offlined in the greenhouse was responsible for significant sales that were not growing, but significant sales nonetheless in the Quebec market. So the theory 12 months ago is, let's offline the space in the greenhouse to make room for new strains that we believe will grow in market in terms of market demand, versus keep strains that we know are flat and that may become declining. So we were a little ahead of ourselves on the consumer adoption curve, so it wasn't quite a declining product. We took cash cows out of the market. And so 9 months later...
Sebastien, I'm sorry, I want to continue with that line of thought, but sorry to interrupt there. Just on that point, I would have thought that you had enough capacity to do both at the same time without taking offline the products that were in the market.
Well, we do now, Pablo. That's the difference. So, and this is why the acquisitions we did were so critical. So by acquiring Cannabis and rolling that in, we now have an extra 450,000 square feet of indoor grow with Atholville. We have additional greenhouse grow with Langley, but the whole portfolio now at HEXO between Redecan, 48 North, and Cannabis is a massive cultivation space, plenty of space. We will never be presented with that strategic challenge again of saying we need to offline productive cash cow strains to be able to put our innovation platform in. And so, of course, long cycle time to strains was about 9 months. And we came out of that issue with the 2 strains that had performed well in our genetics lab, did not perform well in greenhouse, and we were left with some market share loss in flower. Thankfully, we didn't just put 2. And this is where I said it's more a story of like succeeding on 8 out of 10 versus just failing on 2. 12 months ago, we started putting more than 2 strains in our greenhouse, and they're coming out now. The results are phenomenal. I mean, we have phenomenal terpene results. Our lemon haze product selling incredibly well in Quebec. We have a number of other new strains which are productive in greenhouse and that will be highly productive indoor. You see the improvements we've made on Northern Berry with Up. So all that we believe will lead to regaining that flower share in 2 to 3 quarters in Quebec.
Understood. And then just to stay on the Quebec point, so based on the numbers you gave in the call, right? I think sales for Quebec were about 9.8 million, right? In terms of what you supplied, down about 35%, down 5.2 million. You gave us a number. That's a lot of detail. Most companies don't give that, so thank you for that. So I calculate based on the StatCan data, if I gross up your numbers by call it 50%, that you're about 15% share in Quebec. But over time, we should assume you can go back to 30%. And I'm talking to the heritage HEXO business in Quebec. And talk about that in terms of recovering share in Quebec. How does the new acquisitions also help you? Because it's a two-path strategy there, right? Heritage HEXO improving share in Quebec, and also the new acquisitions, how they help you there. Can you touch on that briefly?
Yeah, I think you're a couple points low on the total share in Quebec, but in either case, we have misstepped and we do need to recover. There's no doubt about that. So this is a plan that's already been set in motion. We remain the preferred supplier to SQDC. That has never changed. There's another 2 years on that contract, and we are in discussions to renew that. So the plan is currently accepted. Of all the new strains that we're bringing to market, plus the new portfolios. So of course, we're looking at this as an aggregate, and you're not seeing, when we talk about HEXO Legacy, I think that's doing a bit of a disservice, and that's where we should spend more time on, because this is not just HEXO Legacy. HEXO is now HEXO Cannabis, and will soon be HEXO Cannabis 48 North Redecan. And when Trent was talking about that $17 million per 10 basis points of market share, if you're going to compare apples to apples, the 17 million for the market share is for the consolidated entity. That includes all the M&A. And when we compete and when we compare ourselves to others, we're comparing against M&A heavy companies, right? If you look at any of the billions of dollars in M&A, most of them spending a lot more per market share than what HEXO did. And so when you look at the total portfolio, I think we're already in a very, very strong position in Quebec. So Cannabis has some good points of share. And the most transformative transaction, Redecan, is going to be highly accretive, because that portfolio Quebecers have been asking for, so the consumers. And unfortunately, Redecan on their own were unsuccessful in penetrating the SQDC market. Our conversations with SQDC around that subject have already gone very well, and we expect to bring the Redecan portfolio into Quebec in short order.
Right, understood. And the last question in terms of the 3 acquisitions, again, touch about the other provinces in terms of the synergies there, in terms of where Redecan or Cannabis were under index that you can help, and vice versa. You've talked about Quebec. Talk about the other provinces in terms of revenue synergies within those deals.
Well, I think the great news there is that, I mean, we're the fastest. HEXO proper was the fastest growing company outside of Quebec, and Redecan is also one of the fastest. So year over year, I mean, they were actually, funnily enough, it's the same number. They were actually at 169% growth overall year over year. And so you're taking the 2 most rapid growing brands and you're extending them nationally, and there's no overlap in terms of products. I mean, when I talked about being number 1 and I raised all the categories, the only overlap is flower in terms of where we're competing against each other. I mean, pre-rolled is really Redecan's Ballywick. They've got the number 1 pre-rolled product in the market, the Reddy's marijuana cigarette, which is a phenomenal product. The hash is really HEXO. And as you go down each product category, you really notice that it's really shared. And this is why it was a beautiful, beautiful merger, and why Redecan, even in the face of a bigger bid from some other competitors, they actually got bid 1.4 billion. So we bought it for 960. 2 days later, we had a competitor bid them 1.4, and Redecan told them forget it. It was not accretive. The paper they would have been receiving was not worth it, and they're really seeing the undervalued HEXO stock as a massive step up opportunity. And you really see that from the portfolio strength. HEXO now has the top line strength to maintain its internal sales force. It's one of the largest sales forces in Canada that's properly owned, and as we grow, that actually becomes a competitive advantage. So the broker model, when you're smaller, will cost you 5-6% of sales. The internal sales force actually goes to 3 to 4%. So it actually becomes operationally cheaper to run. And it's also focused on your own product portfolio. So it allows you to develop deeper relationships. Next synergy was on the board relationships. So we now have over 260 listings with all the boards combined. It's a massive amount of listings and one of the massive barriers to entry to get to that retail channel. But more importantly, we now have strategic relationships in all core markets. And that means, so HEXO bringing Quebec, of course. HEXO had recently obtained on its own strategic relationship with Ontario, which allowed for a 6-month load-in of purchase orders, for example. But Redecan had that for a long time. So there's actually 8 strategic relationships in Ontario. HEXO now owns 2 of them between HEXO and Redecan. So, and the same, of course, with BCL, LDB, and AGLC. So those abilities to set dock times in the future, all the logistics are a fantastic tool for us to grow our share and to actually help the provinces as well. Remember that HEXO actually has phenomenal logistics team. We were responsible for the smooth Quebec rollout. I'll remind you, Pablo, that HEXO is actually responsible for all the distribution for all LPs in Quebec. So we took over that contract on day 1 when Quebec launched. And so we've built an amazing logistics capability. We're currently in discussions with some of the other boards on how can we help. And we're really there to do that, to, again, make their business more profitable and make the customer journey smoother.
Before we step back into bigger picture questions, just in terms of the Redecan, and do you have a timing for when the deal closes, Redecan and 48 North? I mean, are we talking, June, July, or is it going to take longer?
We're looking at, oh, sorry, go ahead. Yeah, we're looking at middle of August to late August for 48 North and early September for Redecan.
Got it. And then just a very brief question. I don't think this came up in the conference call on Monday, but can you give just a brief trading update? It's already 6-7 weeks into your July quarter. Just if you can, in terms of underlying sales or order from the boards. It's interesting that regarding the April quarter, a lot of companies would have blamed, inventory cutbacks and SKU cuts by the boards, whereas you have been more upfront and talked about, strain issues and gone into the quarter without giving guidance.
Well, thank you for that, Pablo. I think, first of all, that's something you're going to get with this management team is responsibility. And yeah, we're certainly going to take credit when things go well, but when we screw up, well, it's our fault. And I think the idea is if there are mistakes made, it is critically important that we learn from them to never make them again. And on both the mistakes that happened for Q3, we have systematically and structured environment. After all, that is our job, is to navigate changing circumstances. From a performance, and I'm sorry, just quickly remind me the second part of your question.
Well, when we're looking, we're already middle of June, right? That's 6-7 weeks into your July quarter.
Yeah. We won't guide, Pablo, only to say that the systemic errors that brought us to Q3 are largely resolved. So we're already seeing things be better than Q3, but we won't guide any further than that.
Okay. Now moving into the Powered by HEXO strategy, specifically in the case of Molson Coors, a reminder of what's happening in the U.S., right? In Colorado, you're building a facility. Are you selling CBD drinks and also THC drinks? If so, where? What's the plan there? And just a brief reminder of how much Molson does in the Trust JV. Or is it a lot driven by HEXO?
So the Trust JV has been just a phenomenal relationship. So we recently bought a 50,000 square foot facility in Colorado, which will be the manufacturing facility for all our Powered by HEXO. So we were previously doing contract manufacturing. We are in market in Colorado. We are in most liquor stores in Colorado today with a full CBD only offering. That is CBD derived from hemp. It is fully legal at all levels of government. And that is a commitment that HEXO is maintaining go forward. We're not going to break any federal law. So in part of that, this Colorado facility we just bought already has the THC licensing. So although we're in CBD today, we certainly intend to go into THC very soon as federal regulations permit, or as soon as we can establish a proper structure to do so. So there are a number of synthetic structures that we are looking at that may enable us to comply fully with federal law while having an arm's length company participate in THC. And I may add that
I mean, I'm sorry to interrupt you. On that point, I mean, you could sell THC drinks in Colorado or not. I mean, it's legal there, or you can because of your U.S. listing.
No, it has nothing to do with the listing. It really has to do with federal law and compliance in the U.S. I mean, technically, any THC derivation of revenue from THC is illegal in the U.S. today at a federal level. So although tolerated at the state level, it is not something in which we would expose our reputation or our licenses, and that's on both sides of the JV partnership. We will absolutely maintain good standing with all our licenses, and that's especially relevant for our partner Molson, that of course has federal alcohol licenses.
Because I'm thinking of High Pops, right? In California, Heineken and Lagunitas, they do sell THC drinks there. But I
they
hear
do, they are taking a
company.
risk. Yeah, so they do, and they are technically taking a risk with their alcohol licenses. We haven't seen enforcement there, but we are continuing to work very closely with the regulators. Our intention is not to ask for forgiveness. It's very much an ask for permission strategy. We respect the federal regulators in the US at all levels, and we want to make sure that we get a very clear go-ahead from our structure in whatever we do.
Right. And I understand the Powered by HEXO strategy, of course, is beyond drinks, but this facility that you're saying is going to be for other products also, is Molson Coors involved in that, or that's separate? Because
it is separate. So yeah, no. So let me talk about that structure a little bit. So the JV, 57.5% owned by Molson Coors, and the 42.5% owned by HEXO. We'll currently consolidating the Canadian business into the HEXO financials, but over time we'll consolidate over to Molson, and we'll get 42.5% of the earnings coming out. So, but in terms of how it works in Canada, HEXO does end to end. With Trust, the JV that really handles all the go-to-market, the marketing, the consumer insights. But everything manufacturing, even the things that are for Trust, are subcontracted from Trust to HEXO. The distribution relationships are owned by HEXO. These are relationships with cannabis boards. In the US, and this is where the beauty of the strategy comes in, the distribution relationships are owned by Molson Coors and fed into Trust USA. And so that's what allowed us to get into just about every liquor store in Colorado. And the manufacturing is either subcontracted by Trust USA and Molson Coors to their network of producers, or will be made at Molson assets. So that's still on the come at this point. But the thought process is that the regulatory regime in the US allows us to use legacy breweries, legacy drink manufacturers to switch them over to produce CBD beverages. And so we think that'll be a very capital light approach to the system, much more so than Canada. And the share of shelf right now is already highly indicative of success in Colorado. So we own almost every end cap in those liquor stores in which we distribute.
Understood. Look, I just want to stay on the US, but just bigger picture. You know, some companies, of course, some LPs, I would say, have a very US-focused strategy. You know, I won't mention the name, but I think that, and there's nothing wrong with that. There's others that talk more about the global market, very focused on Europe. How relevant is a US strategy to the HEXO overall strategy? And related to that, you know, what other wins can we expect on Powered by HEXO, you know, skincare, other CPG products? And also as part of the same conversation, when you look at MSOs, we have the Canopy Growth acreage transaction, right? Contingent on federal legalization. We had the Kronos deal on Monday. How are you thinking about, you know, contingent stakes with MSOs, or are you going to pretty much going to wait for federal legalization? And in all these US moves, does Molson Coors have to have a say, or not really? They are just on the Trust JV. I know there's a lot there, but it's about the US strategy overall.
Well, let's start with our partner and our relationship. And Molson's been a phenomenal partner, and they are very much concerned with the JV. So they have no say or direction in where HEXO goes, other than HEXO wants to remain a good partner. So I often interface with the board at Molson Coors to make sure they're aware of what we're doing and to make sure that they don't get surprises. From a values perspective, we're very well aligned. Don't break any laws, right? Make sure put the consumer first. Focus on insights. And so from that perspective, Molson and HEXO are critically aligned, and that will never change. But from an executional operation, we're quite independent. So on that piece for operation, the U.S. strategy is a critical piece of HEXO's growth story. We've recently updated our strategic objectives coming out of being number one in Canada rec. We had set for ourselves a few years ago the objective of being top two. Well, here we are number one, and we've recently updated those objectives to say we want to be top three from a cannabis products perspective in the world. So you can't ignore the U.S. market. What I think is really interesting and a big differentiator for HEXO is I believe we're fundamentally undervalued given where we're hitting, and that gives us some strategic flexibility, and I'll explain how. Let's say we just did what we were set out to do in Canada. We just stayed number one in Canada and did nothing else. You see major accretion to our stock price from that story, right? Imagine an $8 billion market at retail in Canada, $3.5 billion available to the licensed producers, number one position at 30%. You have $1 billion company, right? And obviously we're trading right now at sub that quite a bit. So you have massive accretive potential just with Canada. So that's the first part of the story and why Canada remains very important for us. It's a very important market. It's a very well-developed market, and we're number one in it. So we're going to keep winning there. But when I look at the next most important market, it's the US. I mean, you're talking about a fully developed market that'll be north of $100 billion. So you're leaving about $35 billion for the products companies like HEXO. And so massive opportunity there. So our focus there is really twofold. So one, there's the core cannabis offering. So taking the success we've had in Canada with our pre-rolls, our hash, our oils, bringing that to the US. So, and that will most likely be distributed through multi-state operators. So we are engaging in discussions with multi-state operators to be able to list in their stores when federal legalization or business structure allows. So as that continues to roll out, we expect that we'll be able to improve MSO margins, provide them with a higher quality product in certain categories for their consumers, and overall improve their portfolio. So I think that's a win-win-win. And with us just focus on the manufacturing itself. So in Colorado specifically, we're looking at installing extract lines, pre-roll lines, and hash lines specifically at the moment that could feed that business. The second part of the business and the most the one we've been talking about for years has been the Powered by HEXO strategy. So with the Powered by HEXO strategy, it's very much around making that active syrup that can go into any CPG product. And of course, it'll vary with the technology. So if it's a beverage, it's a nano emulsion platform. If it's a buccal application, we'll use a sublingual technology like a thermogel. If it's going transdermal, then we need transdermal technology, for example. So it's about packaging all those things. That is happening in Colorado. And the goal is to provide, at the moment, a CBD from hemp platform, but eventually a full range of cannabinoids and need states for CPGs to integrate into their products. So where we're developing products in functional foods, in cosmetics, in pet care, up in Canada, taking that IP, exporting to the US, using our manufacturing acumen and facilities in Colorado to produce that, and then to ship that legally to CPGs across the US for them to put those solutions, those cannabis-based need states, into their products. And so that will expand two ways. With more partners, so I talked about those other categories, and then geographically, of course, as we expand to more states, which we expect will, of course, start with our partner Molson Coors very soon.
Just staying on that point, and when I think of other companies, so GI with Bats, Oxy, Imperial Tobacco, Altria, of course, Kronos, I hear the idea here that you can work with many CPG companies at the same time, but I wonder if others maybe are reluctant because they're already working with Molson Coors. I understand that's just beverage JV, but is that a problem, or as you engage in dialogue with other CPGs, or not at all, it's actually an advantage?
It's an advantage, Pablo. Thanks for asking. It's really been the other CPGs we're talking to are quite thrilled. We're partnered with Molson. I mean, Molson has a phenomenal reputation, and so we actually use Molson often to interface with the other CPGs and say, hey, how's your relationship with HEXO? How has that relationship gone? And of course, HEXO has a really good relationship with Molson, so it has been an advantage in securing those partnerships. It does preclude us from certain partnerships. So we are exclusive with Molson on the beverage side. So it does block us from necessarily pursuing other beverage companies, and nor would we want to. But there's still a lot of other verticals that are quite interesting where having a partner like Molson is important. And I think that's been a lot of our focus too, and I think we should talk a little bit about ESG. Our HEXO has recently launched a carbon neutral platform. So every single product produced at HEXO, every single employee at HEXO is now fully carbon neutral. We are fully offsetting all the plastic we produce and put in the environment as well. And that's part of that total package. So between HEXO having Molson as a partner, the leader in ESG, that is attracting CPGs to work with us, and especially considering we have class-leading technology. And when you talk about other partners having, other cannabis companies having CPG partners, what's interesting is that HEXO has demonstrated an ability to go up against some of the best corporations in the world. So I take Canopy Constellation Brands, for example. Constellation is one of the best beverage companies in the world. They were in market in Canada for 6 months ahead of HEXO. And we have displaced them from market leadership to a distant second, with and HEXO remaining at a 46% share. So we've figured out how to make this partnership work. And we have proven to all the other CPGs that when you partner with Powered by HEXO, you are creating and taking a shot with a proven company that could become a market leader in a brand new market. And I think that's very powerful in gaining traction as well.
Understood. Can we just touch on the export markets outside of North America? Obviously, through Cannabis, you have some assets in Europe. You've been exporting to Israel. Just a reminder where you are and how you compare what you have achieved so far in the export markets with, maybe companies that are more developed there, like Tilray or Aurora, or it's so early days that no one is really developed. But just touch on that.
Well, for us, I think that's been the secret to our low SG&A and to our financial performance, and the fact that, from an operating loss from operations perspective, HEXO is the clear leader amongst Canadian LPs. I mean, trailing 3 quarters, we had about 25 million loss from operations. That compares to the next closest LP at 57 million, and it goes all the way to $1 billion loss for the worst, right? For three trailing quarter loss. Europe and export is secondary to our strategy after Canada and the US. HEXO has always been a story of focus. We focused on Quebec, then we focused on Canada, now we're focusing on the US. We will get to Europe. We did acquire a narcotics license in Malta through our Cannabis acquisition. We are currently exporting to Israel. We just had another $2 million hit the books after Q3. So that was very promising, and that's HEXO branded product. But right now it's blotchy. We don't see that market as being fully developed, and so we're not committing hard resources to that market in order to aggressively pursue it. We believe that it will be in startup mode over the next 3 years. So we're monitoring. We're making sure that we have optionality with things like our narcotics license, our GAP certification on our Canadian assets, our GMP compliant protocols, so that we can export. But we're really monitoring, because eventually, if I take you 10 years out, Pablo, what we want to be in Canada, US, Europe, LATAM, we want to be in Asia, but it will all come at a specific time. And we want to be in those markets specifically in adult use recreational, not in medical. And so we're not pursuing the currently existing medical channel. We're using it opportunistically to fix supply chain and get a little bit of accretive revenue in the meantime.
Understood. That's very helpful. Look, I'm going to jump into, there's some questions here coming through the Q&A chat in Zoom. Answer them if you want or don't, just brief. There's one question that says, if I can paraphrase, HEXO has raised capital quite often, significant shareholder dilution. Is that better or worse than peers? I'm probably not paraphrasing it correctly, but I don't know how would you answer that?
Yeah, no, let me answer that, because this is where we get back to use of capital. First and foremost, it is better than peers. If you look at some of the larger LPs, look at Tilray, Free, look at Canopy, And all you have to do is look at their net assets on the balance sheet. They didn't get that through operational cash flow. You know, they used investor funds to raise, to buy all that goodwill, buy all those intangibles, buy all that PP&E. So they have clearly put out into the market way more shares than we have, you know. And if you look at their accumulated deficit for the top three, which is the write-off of all of that goodwill, of all of those intangibles, you'll note that the combination of those two things, what's still left on their balance sheet and what is still left, what they have funded through accumulated deficits, that's where you get ours at 17 million per 10 basis points of market share, compared to, you know, some of the bigger ones that are literally 85 million per 10 basis points of market share. So look, dilution is, people talk about dilution all the time, like this is bad for investors, but it really depends on how you use investor funds. And with us, we have used them in the most efficient way of any LP, and it's not even close. And so, look, we're proud of our historical use of capital funds. We have, in fact, done a lot of M&A recently. And yes, there's a lot of share swaps happening in order for us to do that. But you know, when we pay with our paper, we're paying with really great paper because we are in fact undervalued, which is why M&A has come to us and why we have so many opportunities for our investors. But we're also paying very low multiples. You know, Zenabis we argue, is as good or better than Supreme, and we paid close to half the price that Canopy had to pay. You know, you look at Redecan, we believe full-heartedly that is by far the best remaining LP on the market. They have the biggest, best private LP. They are, you know, extremely aggressive in their growth. They have very, very good profitability, great margins. And we got them at what we felt was a very fair price. And so, look, we think our use of funds has been top notch, and you know, we don't apologize for taking shares, putting it out in the market, and then using those funds to propel ourselves to #1 in market with the highest margin rate, the lowest SG&A as a percent of sale as we go forward, and the lowest net loss of anyone over the last 3 quarters by a country mile. So I think we're doing okay.
That's good. Thanks for that, Trent. Look, another question from the chat room, which is related to that. Monday's conference call, you implied that you may need to raise more equity to fund some of your cash needs. Do you want to clarify that? Just brief answer.
Yeah, no, we will have to. You know, we have things going forward that we're going to want to deploy capital into, specifically the United States and what we're doing in Colorado and elsewhere, in addition to some of the things that we're going to be doing in Belleville to stand up productive capacity for certain verticals that we want to get into with CPG partners. All of that is extremely accretive to our investors, and it's not a bad use of funds by any stretch.
Right. Another quick question. In terms of the revenue being recognized by the Trust JV, is there any U.S. revenue there so far? I would say probably not, right? But will that be reported also under that line item or somewhere else?
Yeah, no, it won't be, because the Trust JV in the United States is owned by Molson Coors. It's the Canadian is really around the licensing of the production facility in Belleville, so they work under our license, which is why it's consolidated. Not the same case in U.S. But there is revenue, obviously a lot of revenue. It just happens to be going up to Molson Coors.
Right. Another question from the chat room. Someone says, I've noticed a lot of HEXO products are out of stock on those OCS for some time. I can't substantiate that, but is that true what they're asking, or?
No, it is. There has been logistical problems that we're all dealing with right now. It's not a reflection of our ability to supply into the market. That's not what this is. This is a logistical problem. There was also a couple of big LPs that stuffed the channel, and it hindered the consumer's ability to get the products that they really love and enjoy from other LPs like HEXO. And so that has been straightened out. We're working with OCS very closely to monitor the situation, and we've already seen the differences come in a very positive way throughout our Q4 right now and going forward. So there's reason to suspect that is a short-lived issue that won't repeat itself.
That's different from the retooling that you had to go through in Quebec. Right?
Yeah, no, Pablo, that's completely different. And as I alluded to it earlier in our call, when I talked about the strategic planning, So when we switch over to strategic planning, we actually get 6 months visibility for purchase orders. So our finished production schedule can actually line up now to that finished production. We're also concurrently investing in configure to order technology. We've been working on this project for about 12 months, which means we should be in a just-in-time inventory position. So HEXO currently ships from bulk finished product to the shelf with the freshest product in market with about 30 days difference. We're going to shrink that to 5 days. And when we get to 5 days, and we also train the retailers to continue to place their orders for HEXO product because they are available, we should be on the shelf and materially improving that. But that's been an ongoing KPI we've monitored for the last year, and it improves every month.
Yeah, a couple of more questions. Someone is asking, how is baked sales selling through?
Great. Yeah, it was a very, very, very successful launch, and it continues to be one of our key drivers in sales volume as we go forward. So we're getting behind that. It's never going to be for us right now. Our thoughts are that it's not going to be a massive portfolio of products, but it does serve to problem solve something around inventory on the 14 to 17%, but very high quality, great cannabis. It's just a little lower THC, and it solves a problem, and it's been a lot
and most importantly, solves a problem for the consumer. Let's remember, because that's why we're here, right? So forget inventory problems. Let's talk about why the consumer wants bake sale. A lot of people cook with cannabis. A lot of people like to pepper in their choice select cannabis that they buy in 3.5 gram formats, but to have a bulk supply that they can pepper in the choice cannabis in with whatever they want to do at home. And that's really what bake sale serves to supply. It's again responding to a black market consumer need that
CPG companies in the future. Then does that mean that we should not expect a large CPG to take a 19% stake in HEXO like we've seen in other companies? It's going to be more the approach with CPG, call it arm's length, JV structure type deals?
Likely, yes. We're not blocking CPG necessarily, and there have been some conversations around equity position. That would not hold up a deal if I had a CPG said, hey, listen, we really want a 9.9%. But if they're talking 19.9, honestly, my conversation with that CPG be just buy the whole thing at a massive premium, right? I would prefer they not just take a controlling stake. I think that blocks a lot of strategic viability and removes a lot of upside when I consider the path HEXO is on. I believe HEXO and powered by HEXO will become a 300-year brand. I think it will become a large CPG over the next 10 to 20 years. So I think right now we'd be doing a disservice to shareholders to give up that optionality.
Understood. I guess the last question someone is asking about that other bidder for Redecan that, I mean, again, if you can answer, but interesting that Redecan would reject the 1.4 billion bid when you offer 960 million. I think you answered already, Sebastien, if you want to add a few words to that.
Well, yeah, I won't name the bidder. I mean, you can take a guess. There's not a lot of companies that can make that sort of bid, but I'm sure it'll come out over time as these points get circulated. I would ask other CEOs, just ask them directly. Did you bid? We'll see if they tell you. But the point is that Redecan is firmly committed to HEXO. HEXO is firmly committed to Redecan because we both believe that the combined companies are completely undervalued. And really, the reason why you say no to 1.4 from the Redecan side is because they see their part in this and building the 300-year brand story, where HEXO, the HEXO Redecan combined story, will be a top cannabis CPG company in the world. And if we achieve that, if you start to think about this global cannabis market as a $300 billion market, the numbers become absolutely staggering. And that's what we're chasing over the next 10 years. And what we did in Canada, it took us 8 years to do it in Canada. We started as the 17th company. We had less money than everybody. We're 2 years behind. Here we are, we're number one, and we've done it by spending less capital than every single other competitor. Yeah, the share price isn't where we want, and it's always a shame when people lose money on a trade. But the thing is, over time, here we are, 17 to number one on the world scale right now. We're in low rankings on the world scale, but we're setting our sights on becoming again top 3, and I think we'll accomplish it by being responsible stewards of capital.
That's great. Thank you, Sebastien. Look, I know we're taking more time than we had planned here. I appreciate you taking the time here. You've been very generous with your time, Trent and Sebastien. Any closing remarks?
Go ahead, Seb.
We're just to maybe close on ESG, to ask all our investors, shareholders, consumers, everybody to please consider the planet when you make your consumption choices, when you make the purchase choices. There are now carbon neutral alternatives to cannabis consumption and stock investing. And that alternative is HEXO. And I challenge all other licensed producers and other corporates in other industries to please look at our model, take responsibility for the carbon that you put in the market, and also take responsibility for the carbon that your employees put into the market through living. It's less expensive than you would think. And if we all did it, we could tackle this climate change problem a lot faster together.
Right. Thank you very much, Sebastien. Thank you, Trent. Everyone have a good day. Thanks.
Thanks, Mel.
Be well. Thank you.